All right, let's dive into this. We're talking housing loan defaults in Malaysia today.
Oh, interesting.
Yeah, it's something that a lot of people are curious about,
Mm-hmm.
especially, well, anyone who's thinking about buying a house or maybe investing in property in Malaysia.
Yeah.
I mean, it's a big decision. And, we want to make sure people are informed about the risks.
For sure. For sure.
So we've got some really great research papers to guide us.
Oh, perfect.
Yeah. One's called Housing Loan Default in Malaysia, an analytical insight and policy implications.
Okay.
That's from 2023.
Mm-hmm.
And the other one's called Malaysian Residential Mortgage Loan Default, a micro-level analysis
Interesting.
from 2021.
Okay.
So, we've got some good stuff to work with here.
Yeah. And what's great is that both of these papers are based on real data from Malaysian borrowers.
Oh, it's so much better than just theoretical stuff.
Absolutely. Real world insights.
Yeah, exactly. So before we get too deep into the weeds, I think it's helpful to kind of set the stage.
Mm-hmm.
Paint a picture of the overall housing market in Malaysia.
Sure.
So what's the situation like there? Is it like a hot market? Are people eager to buy homes?
Yeah, it is a hot market. In recent years, Malaysia's housing market has seen a lot of growth, which is a good thing.
Right, good for the economy.
Yeah, but it has led to some concerns about affordability.
Ah, yeah, that makes sense.
Can people actually afford to buy these homes?
Right.
So, Bank Negara Malaysia, which is the central bank, they've stepped in with some, policies and guidelines.
Okay.
Trying to make sure things don't get out of hand.
It's stable.
Exactly. So they've implemented things like loan-to-value limits.
Oh, okay.
Might have heard of that, LTV?
Yeah, I've heard the term, but to be honest, I'm not totally clear on what it means.
Okay, so imagine you're buying a house.
Mm-hmm.
Say it costs 1 million ringgit.
Wow, that's a nice house.
Yeah. And the bank is willing to loan you 800,000 ringgit. That means your loan-to-value ratio, or LTV, is 80%.
Okay, so the percentage of the house value that's covered by the loan.
Right, exactly. You're putting down 20% of your own money,
Mm,
and the bank is covering the other 80%.
gotcha.
Now, the higher that LTV is,
Yeah.
the riskier it is for the bank.
Oh, why is that?
Well, because they have more to lose if you can't make your payments.
Right, of course. They're on the hook for more.
Exactly.
So both of the research papers we're looking at today, they actually highlight LTV as a really important factor in predicting loan defaults.
Yeah, it's a key indicator.
And that makes sense, right? Like the more you borrow, the higher the risk.
Right, in theory.
But there's this concept that Saha et al. Bring up in their paper.
Yeah.
Endogeneity. You've ever heard of that?
Oh, yeah. It's a tricky one.
Yeah, it sounds kind of complicated.
Yeah, it can be, but it's basically saying that LTV isn't just influencing default, it's also being influenced by other factors.
Oh, so it's not as straightforward as it seems.
Right. So when a bank decides on your LTV, they're not just looking at the house.
Right.
We're looking at you.
Oh,
Your credit history, job stability, all that stuff.
So they're trying to assess how risky you are as a borrower.
Exactly. And those factors, they influence both the LTV you're offered and your chances of defaulting.
No, so it's like this interconnected web.
Yeah, it's all tangled up.
And if you don't account for those hidden factors, you might be underestimating the risk.
Big time. Saha et al. Found that ignoring endogeneity could lead to banks underestimating default risk by a lot.
How much?
Up to 30%.
Wow, that's huge.
Especially for loans with high LTVs, above 80%.
Okay, so that's a big red flag for banks, right?
They need to be aware of this.
They need to dig deeper.
Absolutely. Look beyond just the surface numbers.
Right, it's about the whole picture.
Exactly.
Now, speaking of factors that might influence default risk, I was surprised to learn that both studies found that men are more likely to default than women.
Oh, yeah. That's an interesting one.
I mean, why do you think that is? Any ideas?
Well, we have to be careful about jumping to conclusions.
Right.
But it does suggest that there might be some social and economic factors at play.
Okay, like what?
Well, for example, maybe men are more likely to take on riskier loans.
Oh, that's possible.
Or maybe they're more likely to face, financial difficulties due to things like job instability.
Right.
Or just, life events.
Yeah, that makes sense.
But again, this is just speculation.
Of course.
We need more research to really understand this.
So it's not like we're saying all men are reckless with money.
No, not at all.
Just that there might be some underlying patterns that are worth exploring.
Exactly.
Now, in addition to gender, Adzitadal also found that Malays and borrowers from other ethnic groups, particularly indigenous groups, were more likely to default than Chinese borrowers.
Yeah, and that's another finding that really makes you think.
It does. What could be driving that difference?
Well, again, we have to be very cautious about making generalizations,
Right.
but there are likely a whole host of factors at work here.
Okay, like what? Give me some examples.
Well, access to financial resources could be one
Oh,
factor.
yeah, that's a big one.
Some ethnic groups might have less generational wealth, for example,
Mm.
or they might face greater barriers to accessing credit,
Right, right.
which could lead them to take on riskier loans or have less of a financial cushion when things get tough.
Yeah, those are all really important points.
Mm-hmm.
And it's a reminder that, these economic issues are often intertwined with social and historical factors.
Absolutely. We can't ignore the broader context.
Now, we've talked about gender and ethnicity,
Mm-hmm.
but let's move on to something that I found really surprising.
Yep.
Interest rates.
Oh, interesting.
Yeah, I would have thought that higher interest rates would automatically mean more defaults.
It seems logical, right?
But both studies found that that's not necessarily the case in Malaysia.
Yeah, it's counterintuitive, isn't it?
It is. So why aren't interest rates a major factor in predicting defaults?
Well, I think it speaks to the competitive nature of the Malaysian housing loan market.
Okay, how so?
Well, banks are constantly competing for customers,
Mm-hmm.
so they often focus on factors other than interest rates to manage their risk.
So instead of just jacking up the interest rates for everyone,
Right.
they're looking at a wider range of factors to assess risk.
Exactly. Things like LTV, loan tenure, the borrower's credit history.
Oh, so they're trying to get a more holistic picture of the borrower?
Yeah. It's not just about one number.
It's about the whole person.
Right. Their circumstances, their financial situation.
Okay, that makes sense. But doesn't that make it harder to predict defaults? I mean, if there are so many factors at play.
It does make it more complex.
And that's where indigeneity comes back into play, right?
Oh, yeah. It's always lurking in the background.
Because the interest rate you get,
Yeah.
it's not just random.
Right. It's influenced by all those other factors we talked about. Your
Wow.
credit score, your job history, the bank's perception of your risk.
So there's like a domino effect.
Kind of, yeah. One factor can trigger another.
And it all adds up to a higher or lower probability of default.
Exactly. It's a web of interconnectedness.
Okay, I think I'm starting to get it.
Mhm.
But can we try to make this a little more concrete? Like, imagine a real-world scenario.
Sure. I think that's a great idea.
Okay, so let's say we have a borrower who's really stretching their finances
Okay.
to buy a bigger, more expensive house than they maybe should.
Mm-hmm.
And they opt for a long loan tenure, like 30 years,
Okay.
to keep their monthly payments manageable.
Yeah.
But that means they're taking on a larger loan amount,
Right.
which we know is a risk factor.
Mm-hmm.
So how might those factors, the breaker, a high LTV, a long loan tenure, and a large loan amount, combine to increase their risk of defaulting?
That's a great example.
Yeah.
It really illustrates how these seemingly separate things can work together to create potential trouble.
Oh, okay. Tell me more.
All right, so first, let's talk about that high LTV. They've put down less of their own money. So if housing prices drop,
Yeah.
they could quickly find themselves owing more on the loan than their house is worth.
Oh, I've heard of that. Being underwater, right.
Exactly. And when that happens,
Yeah,
it can be really tempting to just walk away from the debt.
because you've got less to lose.
Right. You've got less skin in the game.
Okay, what about that long loan tenure? How does that contribute to the risk?
Well, a longer tenure might seem appealing because it lowers your monthly payments.
Right.
But it also means you're paying interest for a much longer time.
Oh, yeah, of course.
So it can significantly increase the total cost of the loan
Makes sense.
and make it harder to build equity.
Right, because you're paying off interest for so long.
Yeah, and potentially create a bigger financial burden down the line.
Oh, I see. So they might be more vulnerable to things like job loss or unexpected expenses.
Exactly, because they're stretched so thin.
Okay, and then, of course, there's that large loan amount,
Right.
which adds another layer of pressure,
Larger loans mean larger monthly payments.
even with a longer tenure.
Mm-hmm.
So it's like this delicate balancing act.
It did.
And if one thing goes wrong,
Yeah.
it can throw the whole thing off.
Exactly, and increase that risk of default.
Now, we've talked about those loan characteristics,
Mm-hmm.
but what other factors did the research highlight as influencing default risk?
Well, both studies found that location plays a significant role.
Really?
Yeah. It turns out that where you live in Malaysia can really affect your chances of defaulting.
Oh, interesting. So it's not just about the borrower's individual circumstances.
Right.
It's also about the larger economic environment.
Exactly. Imagine living in, like, one of those booming coastal cities where property values are just skyrocketing.
Yeah. Where everyone wants to be.
Exactly. You might feel like you're, sitting on a gold mine.
Like your investment is totally secure.
Right. But then what happens if, like, a major industry in that city takes a hit?
Oh, like if there's a downturn in, say, tourism or manufacturing.
Yeah, suddenly people start losing their jobs, housing prices plummet, and
Yeah.
those mortgages that seem so safe,
Yeah.
they start to look a lot riskier.
So it's not just about, the individual borrower and their financial situation.
No, not at
Talk about the
all.
bigger picture.
The whole economic ecosystem.
Yeah, like those ripples spreading out.
Exactly, and that's why it's so important to look at these issues from multiple angles.
Right. It's not just about personal responsibility.
It's about broader economic trends, government policies, the whole shebang.
Okay, so we've got individual behaviors, lending practices, and then these larger economic forces all kind of intertwined.
It's a complex web.
It is. And, it's easy to get lost in all the data and the statistics,
Yeah.
but we have to remember that this is about real people.
Oh, absolutely.
It's about people's homes, their families, their sense of security.
For a lot of Malaysians, owning a home is a dream.
Yeah. It's a huge milestone.
And it represents stability, achievement.
It's about putting down roots.
Exactly.
Yeah.
So the consequences of defaulting on a loan,
Yeah.
they can be really devastating.
Not just financially.
Right. Emotionally, too.
It's about losing more than just a house.
It's about losing that sense of belonging, that feeling of security.
It can be really traumatic.
It can. And, it can have a ripple effect throughout their lives.
Oh, that's so.
Well, their credit score takes a hit. It's harder to get future loans.
Makes sense.
It can even impact their job prospects.
So it's a really serious issue.
It is.
Yeah.
And it deserves our attention.
Okay, so given everything we've learned about these factors that contribute to defaults, what can be done? Like, what can banks and regulators do to make the system safer,
Right.
but without, making it impossible for people to buy homes?
Yeah, it's a tough balancing act.
It is.
But that's why research like this is so important.
Why is that?
Because it helps us understand the problem better, so we can create better solutions.
Solutions that are more effective.
And more targeted.
So, for example, we know that LTV is a strong predictor of default risk. So maybe banks could offer lower LTV loans to borrowers who might be more vulnerable to default,
Yeah, that's one option.
or require larger down payments for those higher risk loans.
That's another possibility.
And remember that whole indigeneity issue we were talking about?
Oh, yes. The hidden factors.
Right.
Well,
So banks need to take those into account too,
go beyond just the LTV number.
and really assess the borrower's overall financial situation.
Their ability to repay the loan.
Right. It's about a more holistic approach to risk assessment.
Exactly. But it's not just about banks tightening their lending standards.
Okay, what else can be done?
Well, we also need to find ways to support borrowers and help them manage their debt responsibly.
So it's about education and empowerment.
Exactly. For instance, banks could offer financial literacy programs.
Oh, that's a great idea. Like teach people about mortgages, interest rates, budgeting.
Yeah. Give them the tools they need to make good financial decisions.
Right. So it's not just about restricting access to credit.
No, it's about making sure people are using credit wisely.
It's about building a foundation for financial health.
Exactly. And, regulators have a role to play here, too.
Oh, yeah, of course. Bank Negara Malaysia.
They can implement policies that encourage responsible lending practices.
And protect borrowers from predatory lending.
Exactly. So things like setting limits on LTV ratios, establishing guidelines for debt-to-income ratios.
So it's about creating a regulatory framework that fosters a healthy and sustainable housing market.
Right. A market that works for everyone.
And speaking of working for everyone, we can't forget about those findings on gender and ethnicity.
Oh, those were eye-opening, weren't they?
They were. And they highlight the need for policies that address systemic inequalities.
And ensure equal access to housing opportunities.
Right. It's about creating a level playing field,
So that everyone has a fair chance to achieve their homeownership goals.
regardless of their background.
Exactly. Now, you mentioned earlier that Malaysia has one of the highest household debt-to-GDP ratios in the region.
It's something that economists keep a close eye on.
And for good reason. It can be a sign of potential trouble brewing.
Yeah, like if a lot of people are carrying a lot of debt,
Mm-hmm.
and then something unexpected happens.
Like a recession.
Right, or a sudden spike in interest rates.
People might start struggling to make their payments,
And that can trigger a chain reaction.
leading to a decline in consumer spending, maybe even a financial crisis.
So it's like this house of cards.
Wobbling precariously.
Okay, so how do we tackle this problem of high household debt?
Well, there are a number of strategies.
Give me some examples.
One approach is to promote financial literacy.
Okay, so educate people about the risks of taking on too much debt.
Right. Teach them how to budget effectively, how to make smart financial decisions.
So it's about giving people the knowledge and skills they need to manage their money well.
Exactly. Another approach is to implement policies that encourage saving and discourage excessive borrowing.
Okay, so things like tax incentives for saving.
Yeah. Or setting limits on the amount of debt that households can accumulate.
So it's about creating a regulatory environment that nudges people towards financial prudence.
Exactly. And of course, we can't forget about the role of income inequality.
Oh, yeah, that's a big one.
If a large portion of the population is struggling to make ends meet,
Yeah.
it can fuel a cycle of debt and financial instability.
Right, because people are forced to borrow just to cover their basic needs.
Exactly. So policies that promote job creation, increase wages, provide a social safety net,
Those can help alleviate some of that pressure.
and reduce the need for borrowing in the first place.
So it's about creating an economic system that works for everyone.
A system that's fair, inclusive, and sustainable.
That's a great goal. Now, we've talked about these broad strategies, but I'm wondering if there are any specific policy interventions that might be particularly effective in the Malaysian context.
That's a great question. Are there any innovative approaches that other countries have taken that we could learn from?
I'm all ears.
Well, one policy that has been implemented in several countries, including Canada and Singapore, is a debt service ratio cap.
A what?
A debt service ratio cap.
Okay, break that down for me.
So it basically limits the percentage of a borrower's income that can be used to service their debt, including housing loans.
So it's like saying, okay, you can only spend this much of your income on debt repayments.
Right, to make sure they can still afford their other essential expenses.
As a safety net.
Exactly, to prevent people from getting in over their heads.
And to protect the financial system from too much risk.
Right. Of course, setting the right cap is crucial.
Yeah, I imagine it's a delicate balance.
It is. You want it to be strict enough to mitigate risk, but not so restrictive that it prevents people from accessing the housing market.
Right, it's about finding that sweet spot.
Exactly. Now, another interesting model that's gaining some traction is rent-to-own schemes.
Oh, I've heard of those, but I don't really know how they work.
So basically, it allows potential homeowners to rent a property for a certain period of time. Mm-hmm.
And a portion of their rent payments goes towards building up a down payment.
Oh, that's clever.
So it gives people who might not have a large lump sum up front
Yeah.
a way to gradually work towards home ownership.
And they get to live in the property while they're saving.
Exactly. It can be a really effective way to overcome that initial hurdle of saving for a down payment.
Especially for first-time homebuyers.
Right. Or those with limited financial resources.
So it could be a win-win for both the renter and the seller.
Absolutely. The renter gets to live in the property and build equity.
And the seller gets a steady stream of income and a potential buyer down the line.
Exactly. Now, it's not a perfect solution, of course.
Right, there are always challenges.
But it's an idea that's worth exploring in the Malaysian context
yeah, it's about being open to new approaches.
and finding what works best for Malaysia's unique circumstances.
This has been such an informative conversation. We've covered so much ground.
We have. From those surprising insights about default risk
To those innovative solutions that could help create a more stable and inclusive housing market.
And I love that you always bring it back to the human element. Because at the end of the day, that's what really matters.
Exactly. These aren't just abstract economic concepts.
They have real-world consequences for people's lives.
And their dreams.
Absolutely. So before we wrap up,
Yeah.
I think it's fitting to leave our listeners with a question.
Oh, a good one.
A question to ponder, to spark further exploration.
All right, hit me with it.
Given everything we've discussed about the Malaysian housing market, the interplay of social, economic, and cultural factors.
The need for both stability and accessibility.
Right.
How can we create a system that empowers individuals to achieve their dream of homeownership
Yes.
without jeopardizing the overall health of the financial system?
That is the million ringgit question, isn't it?
It is. And it's one that deserves our continued attention and thoughtful consideration.
Absolutely. It's a question that will shake the future of housing in Malaysia. and the lives of countless Malaysians who aspire to own a home.
You know, as we've been talking about all these factors, the
Yeah.
thing that keeps coming back to me
Yeah.
is that this isn't just like some dry economic issue.
Right.
It's about people's lives.
It is.
You know, their aspirations, their dreams.
It's about giving people a chance.
Exactly. A fair shot at a good life.
And I think those findings about, gender and ethnicity,
Mm-hmm. Those were really something.
they raise some big questions
They do. About fairness.
about whether everyone really has an equal opportunity.
Are there barriers in the system?
Yeah, like are some groups more vulnerable because of things that are, outside their control?
Right. Are there biases that we're not even aware of?
It's uncomfortable to think about.
It is. But we have to.
You have to face those tough questions.
If we want to make things better.
And that brings us back to that question we posed earlier.
The big one.
How do we create a housing market that's both financially sound and socially responsible?
It's a challenge for sure.
It's like walking a tightrope.
It is. But it's not impossible.
So what are the key ingredients?
Well, I think we need banks and lenders to be really mindful of those hidden biases we talked about.
Okay.
And to adopt lending practices that are, fair and transparent.
So it's about more than just checking off boxes.
Right. It's about really looking at each borrower as an individual.
Understanding their circumstances.
Exactly. And we need policymakers to step up, too.
Oh, absolutely. They have a big role to play.
They do. They set the rules of the game, right?
Right? So they can create safeguards that protect borrowers.
And make sure the market is stable and inclusive.
And maybe the most important thing is education.
Oh, I totally agree. Financial literacy.
Empowering people to make informed decisions.
Giving them the tools to navigate this complex world.
So it's a multifaceted approach.
It is. It's not just one thing.
It's about individuals taking responsibility, but also banks and regulators doing their part to create a system that works.
For everyone.
And, at the end of the day, homeownership.
Yeah.
It's not just about having a roof over your head.
It's so much more than that.
It's about security. It's about building a future.
It's about belonging.
And creating those opportunities for everyone.
For all Malaysians.
That's what we should be striving for.
I agree.
So I think that's a good place to wrap up our deep dive.
I think so, too.
We've covered a lot of ground.
We have. It's been fascinating.
And I hope our listeners have found it informative.
And thought-provoking.
Yes. And maybe even a little bit inspiring.
I hope so.
Because this is an issue that affects us all.
It does.
And it's one that we can all do something about.
Whether it's educating ourselves, having conversations with our friends and family.
Or advocating for policies that promote a more just and equitable housing market.
Exactly. Every little bit helps.
So thank you for joining us on this journey.
It's been a pleasure.
And remember, knowledge is power.
Keep learning, keep exploring, keep asking those tough questions.
And until next time, happy learning.